If you're considering the stock market, or perhaps you've already started investing, you've likely heard the success stories, fortunes made, early retirements. It all sounds so good. But for every success, there are many instances of significant losses. Sometimes people lose everything. Seriously. I'm about to break down 25 critical mistakes that beginners make all the time. Mistakes that can absolutely crush your portfolio and your dreams. There are probably way more, but these are the top ones we are tackling in this episode. By the end of this video, you'll be armed with the knowledge to sidestep these financial landmines and actually start building your wealth the smart way. And if you're serious about making your money work for you, hit that subscribe button right now. We're going to cover a ton today. From the most basic planning fails that trip people up all the time to some sneakier psychological traps that even experienced folks can fall into. Plus, I've got a couple of contrarian takes that just challenge what you think you know about investing. Sounds good? Let's get into it. And tell me in the comments what's the one thing about investing that makes you the most nervous. First up, the absolute classic, investing without a plan or clear goals. So here's the question. What are you investing for? A down payment in 5 years, retirement in 30, or just trying to grow your cash? Without clear goals, you're essentially gambling. If you do this, you make random choices, chase unsustainable stocks, and likely panic at the first sign of trouble because you have no anchor. The smart approach is to define your financial goals short-term and long-term. Establish your timeline and honestly assess your risk comfort level before investing. This plan will serve as your compass. Next, mistake number 2, insufficient diversification or none at all.
You're more diversified. When I look at the way you set up your portfolio, it's not as niche as that some of these.
I'm big on diversification.
You're very big on diversification.
Knowing how to diversify well is more important than almost anything. People don't understand this.
Is that an evergreen principle, you think?
Yes, that's an evergreen principle. And the reason I'm saying that, the way it is, it's almost like a casino making its money.
Okay.
The saying that don't put all your eggs in one basket is critically important here. Maybe it's your company's stock or that hot tip from a friend. If that single investment sours, your entire portfolio can be decimated. Imagine a single company's bad news or an industry downturn wiping out a huge chunk of your hard-earned money. That's the ruin. Therefore, it's crucial to spread your investments across different asset classes, for example, stocks and bonds, various industries, tech, healthcare, consumer goods, for example, and even different geographic locations. It's about building a resilient portfolio that can weather different storms. Now, for our first contrarian idea of the way, is too much diversification killing your gains?
It's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got 3, I'd rather be in my best ideas instead of my worst.
So we just said diversify, and for most beginners, that's golden advice. But can you overdo it? Some highly successful investors like Warren Buffett and Charlie Munger have famously favored concentration, investing heavily in a few businesses they understand profoundly rather than spreading their capital thinly. Their rationale is that if you possess deep knowledge, focusing on a few outstanding opportunities can yield superior results compared to owning a small piece of many different things. This leads to what renowned investor Peter Lynch termed diversification, owning so many different assets that your portfolio becomes overly complex, difficult to manage, and likely generates only mediocre returns, while still incurring fees. You might feel safer due to the breadth, but you could also be diluting the impact of your best investment ideas. The contrarian angle here is that while broad diversification serves as a safety net for those lacking the time or expertise for in-depth company analysis, indiscriminately buying dozens of random stocks isn't strategic diversification either. It might merely obscure a lack of understanding. Effective diversification should be thoughtful, aiming to hold uncorrelated assets and not simply more assets. If you're getting started or are early in your journey, this means that you start with broad diversification through ETFs or mutual funds, which handle the allocation for you. However, as your knowledge grows, The quality and your understanding of your holdings are way more important than just the sheer number. Don't let the pursuit of diversification lead you to own a portfolio of investments you don't understand. Mistake number 3, chasing short-term gains and hot tips.
I never know what markets are going to do. I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I'd never felt that I knew it, and I've never felt it was important.
The temptation of quick riches is pretty strong. You hear about that stock guaranteed to skyrocket or jump on a meme stock trend. This is often speculation, not investing. The stock market isn't a magic money tree. If you chase these, you typically buy high when there's a hype, then sell low when it crashes, losing money rapidly. You're playing a game rigged against you. You risk being burned by volatility. Instead, focus on long-term growth and the underlying value of companies. Wealth in the stock market is a marathon built over years, not a sprint. And I'm sorry to kill the vibe. Mistake number 4, emotional investing. There are 2 big emotions, fear and greed, both very potent. Greed pushes you to chase those hot tips or hold a winner too long, hoping for even more. Fear makes you panic sell when the market dips and avoid investing altogether. Emotional decisions are almost always bad financial decisions. You'll buy high due to FOMO and sell low in a panic. To counteract this, adhere to your predefined investment plan. Automate your investments to reduce impulsive actions. Understand that market fluctuations are normal. If you cannot sleep, your risk level is too high. Time for contrarian idea number 2. The standard advice here is never panic sell. Hold on, stay the course, and 90% of the time for a diversified long-term investor, this is solid. But Charlie Munger had a great way of thinking about problems using a concept called inversion.
Charlie always says, all I want to know is where I'm going to die, so I'll never go there. So, yeah.
Applied here, you ask what guarantees failure? Holding a stock to 0? What if a company's fundamentals are permanently broken? A scandal, obsolete tech, total mismanagement, hype? Is rigidly holding on heroism or just watching your money vanish in thin air? Investor Ed Wackenheim in Common Stocks and Common Sense stresses asking what has truly changed and how it affects the investment's value. Sometimes the answer is everything has changed for the worse. The mistake isn't solely selling in panic. It can also be the failure to act decisively when your original investment thesis is shattered, irrespective of the overall market sentiment. More than market timing, it is about recognizing when a specific investment is a lost cause. Distinguishing between temporary market irrationality and a permanent impairment of capital in a specific investment is a difficult but critical skill to develop. Now for mistake number 5, not doing your homework.
And I think the people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out.
If you cannot explain what a company does and how it generates revenue in a simple manner, you probably shouldn't own that stock. Investing in complex derivatives or obscure biotech companies without comprehension is a recipe for disaster. The solution is to stick to businesses and investment products you can understand. Read company reports, understand the industry, and know its competitive landscape. Invest in what you know remains valuable advice. This leads to mistake number 6, overtrading. Constantly buying and selling, trying to catch every wiggle. Every trade incurs costs and potentially taxes. These transaction costs eat into returns, and you're more likely to make emotional mistakes. It's a fast way to churn your account down to nothing. A better approach for most of your portfolio is to buy and hold strategy. Only trade when your investment plan dictates or when fundamentals significantly change. Mistake number 7, ignoring fees and costs. Seemingly small percentages for fund management, brokerage commissions, or advisory fees can accumulate substantially over time, significantly diminishing your long-term returns. An extra 1% fee on a $100,000 portfolio over 30 years can cost you tens of thousands of dollars. To mitigate this, opt for low-cost index funds or ETFs. Understand all associated fees with any investment or advisor and minimize unnecessary transaction fees. Next, mistake number 8 is a significant pitfall: using leverage recklessly. Borrowing money from your broker to invest can amplify gains for sure, but it can equally magnify losses. A small market downturn can trigger a margin call, forcing you to sell at the worst time or deposit more funds. This can lead to losing more than your initial investment and even incur debt to your broker. It's one of the quickest ways to be financially ruined. As a beginner, avoid margin trading. If you consider it later in your investing journey, ensure that you understand it thoroughly. Mistake number 9, blindly following the crowd or herd mentality. Everyone's buying X, everyone's selling Y. Going with the flow feels safe, but the crowd is often wrong, especially at market extremes. You'll be buying at the peak of euphoria and sell at the bottom of despair. Develop your own judgment based on your research and plan. As contrarian trader Jason Shapiro implies, going against prevailing positioning can be an edge, though it's challenging. Often the best opportunities are found when they're out of favor.
We're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down.
Mistake number 10, misunderstanding your risk tolerance. How do you actually react when your investments decline by 20 to 30%? Many people overestimate their ability to tolerate losses until they experience them. Risk management and tolerance involves willingness, ability, and the need to take risks. Many overestimate their stomach for losses. Taking on more risk than you can actually handle leads to panics during downturns and abandoning your strategy. So please be honest. Start conservative if unsure, and your portfolio should let you sleep at night. Mistake number 11, not rebalancing your portfolio. Over time, some investments will grow faster than others. It just happens. Skewing your original asset allocation. If stocks soar, they might become a much larger and riskier part of your portfolio than intended. Your portfolio becomes unintentionally misaligned with your plan. To address this, periodically, maybe annually or when asset allocations drift significantly, sell some of your outperformers and buy more of current underperformers who you believe will have their time in the sun to return to your target asset base. Mistake number 12, trying to time the market. Attempting to consistently predict market peaks and troughs by buying low and selling high is an exceedingly difficult, let me repeat, exceedingly difficult, if not impossible task for most people. Even professionals struggle.
I think that just the way you said it is going to be a fool's journey. To say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts.
Success requires being right twice, when to exit and when to re-enter. Trying to time the market often results in missing the best market days, which account for a large portion of long-term returns, or being caught in downdrafts. Instead, focus on time in the market, not timing the market. Invest consistently over the long term. Mistake number 13, letting tax consequences dictate investment decisions. This involves holding on to a poor investment solely to avoid capital gains tax or selling a strong performer prematurely for a minor tax gain. This can lead to suboptimal portfolio either by retaining losers too long or selling winners too soon, purely for tax reasons. Investment decisions should primarily be based on fundamentals. Understand the tax implications, but don't let them be the main driver of your buy or sell choices. Mistake number 14, believing this time it's different. Whether it's a new tech bubble or a crash, the narrative may emerge that old rules no longer apply. History shows that market cycles and human psychology tend to repeat themselves. Believing it's different this time means you overpay during bubbles and panic sell during crashes, assuming that the current trend will last indefinitely. Instead, study market history, maintain healthy skepticism. Cycles are absolutely normal. And don't overlook mistake number 15, inflation.
Investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio.
Keeping excessive cash safely in low-yield savings accounts or uninvested means inflation is silently eroding your purchasing power over time. This safe money loses real value year after year, and you're not even growing your wealth sufficiently to outpace rising costs. Invest in assets that have the potential to at least outpace inflation long-term, like a diversified stock portfolio. A significant issue is mistake number 6, which we're talking about next. Having unrealistic expectations. Expecting to double your money every year or achieve returns far above market averages leads to disappointment, chasing risky strategies, or even potentially abandoning investing altogether. Even if not perfect, it is at least better to understand historic market returns, example the S&P 500 average, and set achievable goals based on your risk tolerance and time horizon. Mistake number 17, paying for overpriced advice or gurus. You'll most likely encounter expensive courses, newsletters, or advisors promising secret formulas for guaranteed returns. You waste money on useless information and may even be led into poor choices. So please be skeptical of anyone promising guaranteed riches. Focus on reputable, low-cost educational resources. If you're using an advisor, ensure that they are a fiduciary so that they are legally obligated to act in your best interest and their fees are transparent and reasonable. Mistake number 18, getting stuck in analysis paralysis. Researching endlessly, waiting for the perfect time or the perfect stock, and never actually investing. Sometimes you just gotta leave procrastinating and act. You might miss out on potential growth and compounding by staying on the sidelines. While diligence is key, accept that there's no perfect investment. Start small once you have a basic plan and then move from there. Mistake number 19, confusing a bull market with investment prowess. When the overall market is rising strongly, it is easy to feel like an investment genius. The overconfidence can lead to excessive risk-taking, believing you cannot lose, only to be humbled when the market turns. The key is to remain grounded, recognize the influence of broad market trends on your portfolio, and stick to your strategy even when making money seems easy. Mistake number 20, not knowing when to cut losses. Stubbornly holding on to losing stock, hoping it'll come back even when the company's fundamentals have dwindled significantly, is often driven by an unwillingness to realize a loss. A small loss can turn catastrophic as you tie up capital in a failing venture. This is often ego-driven, unfortunately. If the original reasons for investing are no longer valid or prospects have severely worsened, consider cutting your losses. Mistake number 21, investing money you cannot afford to lose. Using your emergency funds or money needed for near-term essential expenses can be quite risky. A market downturn could force you to sell at a loss or cover essential expenses, derailing both financial stability and investment goals. That's why only invest money that you won't need for at least 3 to 5 years, or preferably longer, and always maintain a separate, easily accessible emergency fund. Mistake number 22, ignoring global events and macroeconomic trends.
Jobs and factories will come roaring back into our country.
Making things, building things, working with our hands is America's heritage.
Thinking that your domestic stock picks are immune to global economic shifts, interest rate changes, or geopolitical events is short-sighted. Your portfolio can be blindsided by these larger factors. A Avoid this by staying informed about broader economic trends and understand how factors like interest rates, inflation, and global trade can affect different asset classes. Watch my video on deglobalization to get a flavor of what we're talking about here. Mistake number 23, chasing dividends blindly. Focusing solely on high dividend yields without scrutinizing the company's underlying financial health or its ability to sustain those payments can be problematic. A company in financial distress might cut its dividend, leading to both a loss of income and a drop in stock price. A very high yield can also sometimes be a warning sign. Instead, look at the total return, dividends plus capital appreciation, and ensure that the company has strong fundamentals and a strong and sustainable payout ratio. There is an entire future episode about how depending on a dividend strategy doesn't work. We'll get there eventually. Almost there. Key for long-term success is to avoid mistake number 24, failing to learn from your mistakes and successes. Repeating the same errors or not understanding why a particular investment succeeded or failed means you're unlikely to refine your investment strategy over time and are prone to repeat costly blunders. A helpful practice is to keep an investment journal. Analyze your decisions. What was your thesis? What actually happened? What can you learn for the next time? And finally, mistake number 25, thinking investing is only for the wealthy or experts. Many people believe that you need substantial money or a finance degree to start investing, but that isn't the case. This mindset keeps people out of the market, causing them to miss out on sometimes decades of potential compound growth and the opportunity to build long-term wealth due to intimidation or misinformation. The reality is that you can start small. Brokers offer fractional shares and low-cost ETFs. The most important step is to begin learning the basics. Consistency over time is more impactful than large initial sums of capital. Whew, that was a rapid fire. If your brain is buzzing, here's a super quick recap. Don't just gamble, always have a plan. Spread your risk wisely, keep your emotions in check, and most importantly, never stop learning. These are the major cornerstones. Investing isn't always black and white, and building wealth through the stock market is an ultra marathon. It requires patience, discipline, and a commitment to lifelong learning. Avoid these mistakes, adhere to a sound plan, and you will dramatically increase your chances of success. So, what's the biggest takeaway for you from these 25 mistakes? And what other beginner investing topics are you curious about or struggling with? Let me know in the comments below. Subscribe for more straightforward breakdowns of the world around you. And don't forget to hit that like button if this was valuable. Thank you so much for watching. Now go out there, invest wisely, avoid these pitfalls, and start building that financial future you deserve. Have a great day.